Today I want to answer the question, is my inheritance taxable? Hey everyone, Nick Nielsen, Certified Financial Planner. Today I want to go over the 6 common account types that you may inherit. First, an annuity. 2 different types of annuities that you might inherit, one being an IRA, the other being a non-qualified account or an account that's not part of a retirement plan. So with an IRA, all of those dollars have been tax deferred. So all of that money would be ordinary income when you receive that from an annuity. However, probably the more common would be a non-qualified annuity. This means that the initial contribution has already been taxed. So let's use the example that someone put $100,000 into a non-qualified annuity, and that just means that it's not part of a retirement plan. And over time, that 100 grew to 150. That $50,000 has grown tax deferred. When that annuity is liquidated and paid out to the beneficiaries, that taxable gain of $50,000 will come out first, and that will be taxed as ordinary income. Now, I will say there are a couple of exceptions to this rule. If you inherit a non-qualified annuity, you would want to look at what's called a post-death 1035 stretch and see if that makes sense for you. There are even a couple of annuity companies out there that have private letter rulings with the IRS that allow you to take some of the gains with some of the bases to reduce the tax liability. The second common account type would be a pre-retirement plan, such as an IRA or a 401k. Once again, that money has never been taxed, so it's going to be 100% taxed as ordinary income. Generally, those accounts are going to have to be liquidated within 10 years. Next, the Roth IRA. The Roth IRA distributions are going to be tax-free. However, they also have to be liquidated within 10 years. Some exceptions may apply. Next, brokerage accounts. With a brokerage account, you receive a step-up in basis. So let's say mom and dad bought a stock for $10,000. Over time, it's grown to $100,000. At their passing, your step-up in basis is now $100,000. So if you sell that stock at $102,000, you would have $2,000 of a long-term capital gain. Next, you would have bank accounts also receive a step-up in basis. So no taxable events with a bank checking, savings, or CD. Finally, life insurance always comes out federally and state tax-free. However, with life insurance and all the other account types that we've discussed, state tax could apply. In summary, you don't want to assume that the money that you're receiving from an inheritance is going to be tax-free. You want to look at the source of each piece of the inheritance to determine the account type, whether it's going to be taxed as ordinary income, whether it would be tax-free through a step-up in basis, or whether you would have capital gains. All of these different accounts are going to be taxed differently, so you have to follow the source of the inheritance to see how it affects you and your family.